Good morning. Banks are easing CRE reserves as their new risks build in the market. In the commercial real estate or CRE market is sending mixed signals right now, and smart investors are paying attention. On one hand, US banks are reducing their credit loss reserves on commercial real estate loans, which signals their improved confidence after years of tightening. On the other hand, in the macro environment, this heading into 2026 is shifting in ways that could quickly reverse that optimism. So the result, a market that looks stable on paper but carries increasing forward risk is what the Fed's going to interpret as well. So, what the data is saying, backwards looking strength. So, in quarter four of 25, banks lowered the reserves levels tied to commercial real estate exposure. And this move was supported by stable delinquency rates, flat to improving charge offs, increased borrower demand, and gradual easing of lending standards. And from a credit performance standpoint, this suggests stabilization after a prolonged period of stress across office, retail, and certain multifamily segments. So for lenders, this is a signal of regained confidence. For investors, it may look like the bottom has been formed. But here's the issue. These metrics are always lagging indicators. So the real risk right now is what's coming next. And as we move into 2026, the forward looking environment tells a very different story. We have the potential for rising interest rates since the Iran contract is driving up some volatility in the market. And higher rates directly impact commercial real estate in three ways. There's refinancing risk for existing loans, which is going to increase as the debt costs rise. But also debt service coverage ratio would tighten, and then the loan proceeds shrink, forcing borrowers to bring more equity. And this is especially critical for assets financed in the low rate era that are now approaching maturity. And there's a large wall that is approaching maturity. Two is cap rate expansion is pressuring values. So when rates rise, cap rates typically follow. And that means property values will decline even if the net operating income stays flat. But equity positions compress and exit strategies become less predictable and less profitable. And this is where many investors could get caught off guard. Got caught off guard. Say that three times fast. But they underwrite to current conditions and not future ones, is the point. Three, geopolitical risk is re entering the equation. With global instability, and particularly with tensions involving Iran, it introduces additional uncertainty. So, potential energy price volatility. And I think we're seeing gas prices rise, but that impacts Houston directly as well. But also capital market disruptions with investor hesitation and liquidity pullback. And these aren't theoretical risks, they're directly influencing lender spreads, investor sentiment, and deal velocity. So, what smart investors are doing right now? Well, institutional and experienced CRE investors aren't focused on what's just happened. They're positioning for what's next and what's coming around the corner. And here's how you do that. One is structure for refinance risk. So prioritize lower leverage and stress test your DSCR at higher rates to predict better performance, but also building liquidity, having 6 to 12 months minimum in reserve. Two is underwriting exit cap rates conservatively and assuming the cap rate expansion, not compression, continues. Modeling downside scenarios and prioritizing cash flow over appreciation bets. Three is focusing on durable asset classes like industrial and logistics or retail tied to population growth, because retail follows rooftops, but also essential service tenants. Four is prioritizing structure over rate. And this is where most deals are won or lost. And the best investors understand that structure beats rate every time. But also prepayment flexibility and rate lock strategy, as well as extension options and reserve requirements. All of these factors determine long-term performance, not just the interest rates. So, why banks are sending mixed signals? Well, not all lenders are aligned, and some have different strategies. And while some banks are easing reserves, others are also increasing reserves selectively on certain product types. Think office, for example, but also potentially construction too. Tightening underwriting standards means they're pulling back from certain asset classes. So, office or transitional deals is kind of what I'm alluding to. And that divergence tells you one thing, that risk perception right now is not uniform. And when banks disagree, opportunity as well as risk both increase. So, what this means for the commercial real estate market. And here's some things you can expect as trends in 2026, but refinancing pressure increases across pretty much every leveraged asset. But transaction volumes can remain muted and price discovery continues. There's no sharp rebound yet. And capital's still cautious and selective. But when we kind of open that door, we're going to push through. And we're not in a crash scenario. We're just in a recovery phase. We're in a transition market. The bottom line for the day is that the commercial real estate market is shifting from stabilization into uncertainty. And banks may be easing reserves based on past performance, but forward risks are building, which could reverse that course. And hopefully not, but it could mean higher interest rates and cap rate expansion with all this geopolitical instability. The takeaway is don't underwrite based on yesterday's data, structure for tomorrow's risks. And that is it for the day, my friends. Please visit HoustonRealEstateBrokerage.com to figure out how to get a hold of me. Love to talk to you more and have a conversation. Have a good day.